Okay, let's get started. Welcome everyone to the Synchrous Town Hall meeting. I am Ryan Durant. I will be moderating today's discussion. You'll hear from each of our speakers on topics both timely and relevant to your concerns as public housing authorities and providers of affordable housing. We invite your questions. If you would, please type your questions using the Q&A function in Zoom. You can do that at any point during today's town hall. You'll find that button in the Zoom toolbar. Look for the label Q&A and the icon which has two speech bubbles. Our panelists will answer your questions at the end of today's session, and we look forward to active participation. With that, we thank you for being with us here today. I'll turn things over to Bill.
Hey, good morning, everybody. Thank you for attending this. This is our annual town hall meeting where we discuss rates and some of the pressures that we're feeling for the renewal for the upcoming year will be January 1st, 2024. I'd like to introduce our panelists today. We've got Cindy Steele, who is our Director of Risk Management and Underwriting. Cindy is our newest employee. She's been with us just about 6 months now and doing a spectacular job filling the void left by some other of our risk management people in the past. And we have Tom Williams, who's our Deputy Claims Director, who's been with us about 1.5 years now. And Tom and Cindy both are part of our succession plan because we have a lot of employees that will be leaving the employment of Synchrous coming up in the next 3 to 5 years due to retirement. So we are rebuilding, and Tom and Cindy are certainly a big part of that. Also introducing Rick Gilhar. He is the Director of Claims. He's been with us for 23 years, and he is the next retiree going out the door. My name is Bill Gregory. I'm the Executive Director of Synchrous, which is made up of the Housing Authorities Risk Retention Pool, or HARP. We will refer to that as the Public Housing Authorities throughout this presentation today. Also the Executive Director of the Affordable Housing Risk Pool, and we'll refer to that through this presentation as the Affordable Housing Providers. And I am also the President of the Orwaka Agency Insurance Services, LLC, which rounds out the 3 entities making up Synchrous, taking policies and coverage needs to the open market if we can't cover or we will not cover them in our risk sharing pools. So with those introductions, I just want to give a brief outline of what we're going to talk about today. I mean, we are all faced with the insurance nightmares of the last 3 to 5 years. Synchrous is certainly not it's certainly not been spared some of the misery of the insurance market. So we rely very heavily on reinsurance. That has been a very difficult market for since 2019, 2020. So we will kind of cover some of the issues that we have running into the 2024 renewal season with our reinsurers. And I will say, because typically I'm the bearer of bad news when it comes to rates and insurance coverages and stuff like that. But for the first time since 2019, I actually see some signs, very subtle signs of improvement in the marketplace, at least as it's affecting us on the West Coast. So I will share more about that with you in a little bit. May I have slide 2, please? So I wanted to start out talking about the performance of the pool. So we have not had what I would consider a stellar year for 2023, 9 months into the year. So right now for the Public Housing Authority pool, we are about 49% over budget. So we are tracking about a $3.1 million loss. Our budgeted surplus that we had back in January 1, we were looking about a $375,000 surplus for the year. So you can see that our performance on the claims end of the Public Housing Authorities pool is falling far shy from what we anticipated it would be. For the affordable housing providers, we projected a $1.3 million surplus at the end of 2023. So you can see that we're showing a little bit of a surplus position, but far off of our expectations. So once again, the claims are what's driving our issues right now, and it's not claims that are penetrating the reinsurance layer. These are claims that are within our self-insured retention. Now, self-insured retention, for those of you who don't know, is the retention that we have for each one of the pools. So in HARP, the pool retains, the members of the pool retain the first $2 million of every loss. So if it exceeds $2 million, it goes to the reinsurance that we purchase on the outside of the self-insured retention. We have had some claims that have penetrated that had to be reported to the reinsurance, but we, like I said, we retain that first $2 million of every losses. There's 82 members. We've had a lot of losses in 2022, 2023 that are affecting that. On the AHARP side, we self-insure the first $1 million. So any claim that happens within the first $1 million is retained by the pool. If it exceeds $1 million, then it goes out to the reinsurance. And we've had 2 of those claims over the last 2 years that have actually penetrated that $1 million retention of ours and went to the reinsurance. And that's part of what's driving reinsurance renewals for 2024. We'll cover some of the issues that we're confronted with for the 2024 renewal. This is one of them. Supportive housing is another one of them. But more importantly, it's the total insured values, where we have our total insured values being reported by our members are being looked at very closely by reinsurance. And 2024 was one of those pivotal years where they looked very closely at the TIV's total insured values and felt that they were underreporting, that we as a pool were underreporting to them. So we will cover that more in detail in a couple slides from now. For 2022, 2023, HARP had, well, the public housing pool had 7 large claims that exceeded $350,000. We had a couple that were pushing that $2 million loss. These are property losses. So we did have some extreme claims activity in the public housing pool for 2022, 2023. On the flip side, for the affordable housing providers, we had 8 large claims that exceeded $250,000. 2 of those went into the reinsurance. So that means those were in excess of $1 million. So we did not have a very good year in 2023. It was kind of fed from the 2022. I looked at it early in the year as an anomaly because we had such a very destructive winter, but these trends are proving otherwise. These are just large losses, and I'll cover what's driving those large losses a little bit. And speaking of losses, I'd like to move over to Rick Gelhard just to give you an idea of what Rick and Tom and the other claims crew are seeing out there on the claims handling front of what is actually going on, what's driving some of the rate increases that we're seeing on our renewals again for 2024, and just give you a kind of feel for some of the dangers of what we're experiencing right now from our pool members. So with that, I would like to introduce Rick Gelhard, and he's going to run through some material for you for the next 15-20 minutes.
Thanks, Bill. Bill asked me to talk briefly about where we're seeing a lot of the claims, the increase in claims costs. We can talk about frequency, but frequency at this point is not the real driver of our claims costs. What we're seeing the last, I'm going to say the last 3 years. I'm going to touch on a few highlights of the things that are driving the increase in claims, ultimate claims cost, and then I have about 3 at the end. I have about 3 minutes or so to talk about insured value and the consequences of not insuring the value. But I first want to start with talking about the increased claims cost. I'll start with the property side. As everywhere, we're seeing a huge increase in labor and material costs. That I guess it's happening everywhere, but we are seeing a huge increase in the property reconstruction, repair costs, and those have to do a lot with not only the increase in labor and materials, but we are seeing an increase in code and regulation enforcements. As an example, years ago, you didn't have to go into a mitigation company didn't have to go into a loss and test for asbestos and lead and mold before they even started. Those regulations are tight in all the states that we do business, and those regulations have increased our mitigation costs from restoration companies who not only has their labor and material costs gone up, but they're now required to go in, and we have to hold up the process by doing the testing for asbestos before they can even start the mitigation process. They test, and then they have a lot of regulations, and we won't get into all the details. I think a lot of you already know about those, but that has really increased the cost of mitigating, like a water restoration. When we have water losses or fire losses, when we get in there to do the initial mitigation. Not only that, we've seen a real increase on the liability side as well. The liability side, the attorney fees are going up immensely. Attorneys that we used to pay $200 an hour for, $175 or $200 an hour, are now charging $300 to $350 an hour as the regular rate for an attorney these days. And the other thing that we're seeing a lot of litigation claims that have attorney fees provision. By that, I mean, if the plaintiff is awarded any money at all, we owe their attorney fees. And so, and we're seeing, I'm going to use California as an example in a couple areas here, because that's where we're seeing a lot of the huge cost increases. As an example, in California, we had a case recently where the attorneys on the other side were using two attorneys, and each of them, the court agreed that their $600 an hour labor fees were appropriate. And so you can imagine that if we had a case in litigation that was in litigation for 2 years or a year and a half at $600 an hour times two, you get a plaintiff's verdict for even $5,000, and you have over $1 million in attorney fees that you have to pay. Those are the things that we're seeing. Not only that, but we're seeing juries. I don't know what it is, but since I'm not going to blame COVID, but since it just seems coincidental, but since COVID, juries are awarding a huge amount of verdicts, a lot higher verdicts than we have ever seen in the past. We're seeing the insurance industry is calling them nuclear verdicts. But I don't know even if it's not what they consider a nuclear verdict of several $1 million, for some reason, juries are just throwing out $1 million awards like it's nothing anymore. It used to be, $100,000 or $200,000 verdict award was standard. Now it's high six figures or $1 million. Those are all the things that are really driving up the cost of our claims. We could harp on the increase in labor and materials, but there's a lot of other ancillary things that are causing claims to go up across the board. And where it ends, hopefully we're going to come to the peak and things are going to smooth out here, because that's really what's causing our claim costs to go up. And just I want to change gears a little bit here, talk about property claims. We are insured to value, what we call TIV, or total insured value, and how important it is for each of you, our members, to make sure that you are insuring your properties to value. Because on the claim side, we are seeing a lot of our members that are underinsured. In other words, we depend on our members to tell us what the local cost is to replace your properties. As most of you probably know, if you don't, I'll remind you that both the AHARP and HARP coverage agreements pay full replacement cost coverage. If you have a property loss, we are going to pay to replace that with new carpet, walls, paint, appliances, whatever. We're going to replace it with new. It's going to be like, kind, and quality. In other words, the kind of like, kind, and quality of what you had prior to, but we're going to pay the full replacement cost for that. And what we're seeing is the cost of reconstruction and repairs are just going up exponentially. This slide that Bill put up here shows this is the average cost per square foot in the 4 states that we do business. And you can see California is obviously the highest, but we are seeing costs to repair and replace buildings that are even much higher than this. So we really depend on you because of the local jurisdictions, your cost to repair or replace in your area can vary from even these state figures. So it's really important that you guys do your own research and make sure that you're insuring your properties to value. Where we can give you an average of the state, but that doesn't tell you in the rural areas it may be plus or minus than these figures that we've got on the slide here. And as an example, I'm just going to wrap this up real quick and give you maybe 3 examples of members who were underinsured and the ramifications of being underinsured. Nobody wants to have a total loss, but just as an example, I'm not going to name names, obviously, but one example is we had a fire loss in a rural area in Washington, actually, and this was a 5-building complex, apartment complex with 5 buildings. One of the buildings sustained extensive damage, almost a total loss. It was an RDA property. They had that property insured, unfortunately, for only $150 a square foot. Now, this was a property that didn't have capital money or equity in the property, and they were struggling with it, and so they were trying to cut corners. But what happened? The ultimate issue was that they didn't have enough coverage to repair or rebuild that building. So there was a lot of discussion back and forth with the RDA and with another lender. And what they ended up doing was taking what we call an ACV cash out, an actual cash value. I had mentioned previously about the full replacement cost coverage that we have on our coverage agreements. We also have an actual cash value. In other words, to qualify for replacement cost coverage, you have to actually repair or replace that property. If you don't, we're going to pay for the damage, but it's a depreciated amount. In other words, we take depreciation off for the building materials and the building and things like that. And I think a good average is probably about 30% of the full replacement cost. So the actual cash value is probably 30% less. So ultimately what they decided to do was just demolish that 5th building. That's 1/5 of their units. They just demolished that 5th building and took the actual cash value cash out from us. And that's what they used to fund their capital and maintenance on the other 4 buildings. That's one example. Another example in California, the horror stories in California about the costs going up. This is a recent claim. They thought that they had enough insurance. They were insured for $444 a square foot. It was a duplex. It was a fire loss. The unit where the fire started was basically a gut. It was totaled. The adjacent unit didn't have as much damage. But anyway, long story. That building is now costing $600 a square foot to repair. They are woefully underinsured on this duplex. And so basically they're about $200,000 underinsured for us to repair. So we're in the middle now of trying to decide what are they going to do? Are they going to make up that $200,000 that they didn't have insurance for? Or anyway, that's just a story that and as a claims person, we don't want to be involved in those situations where we have to tell you, unfortunately, you don't have the limits to fully repair or replace your properties. I think I've taken up enough of my time. I do know that there's some other, we had several other properties that have been underinsured recently. They've had to either change the footprint of their properties when we rebuild them. We found a couple during the wildfire season where we had to demolish the entire properties, but since they weren't fully insured, they ended up shrinking the size of the property that they rebuilt. Those are just some of the examples. And if you guys have any questions at the end, I'd be happy to. These are all general comments that we've seen over the last 3 or 4 years. So, Bill, back to you.
All right, thank you, Rick, for that. As Rick alluded to, we rely on our members and our policyholders to give us the TIVs being spread out over 432,000 square miles on the West Coast. It's very difficult for the staff to know what's going on in your local jurisdiction. So for the last, good Lord, 5 to 7 years, we've been at renewal. We've been hammering at the renewal process to look at your TIVs and make sure they're in line with what you are experiencing in your jurisdiction. Best suggestion we had was talk to your general contractors about what replacement cost is, et cetera, et cetera. So in the old days, when I first started almost 18 years ago, HUD would release some cost modifiers for TIV, for total insured values. And we would, as a pool, apply that modifier on a global basis for everybody. So we were keeping at least somewhat of a pace with what the actual cost of replacement was based on HUD's number. HUD suspended that service probably, I'm guessing probably around 2009, 2010. So as a pool, we went out with Marshall and Swift, and we were replicating what HUD was providing. As the years went on, the reliability of the numbers got worse and worse. So we basically went back to drilling the point home to our members and stuff, that you report the TIV to us, and you guys know what's going on in your communities better than we do. So that's what we've been booking on. I have, over the last 10 years, taken small incremental global increases in TIV. I believe I took a 2.5%. I think I took a 3% back in the late teens, trying to keep pace with that. And in 2019, 2020, when COVID hit and we got all these increased costs with reinsurance, I suspended doing that, trying to keep the costs down. So my bad, we are now where we are right now. We have woefully inadequate insured values for most of our buildings. So I threw the statistic up on this slide to show you that in the public housing pool, we have about 34% of the buildings that are above a 225 per square foot. We have determined that 225 as a minimum TIV is what the reinsurers will need, because for the first time ever, the reinsurers on our renewal for 2024 are paying very close attention to what our TIVs are. They are looking back on our records on what TIV has been reported for the last 5 years, and we have developments that still have the same TIV value they had 10 years ago, 5 years ago, 6 years ago. So they're looking at that going in the scheme of inflation. This is inappropriate. So we weren't held hostage for 2024, but they made it perfectly known that, coming back in the future for partnership would be dependent on us getting our TIVs back in line to what reality is. So 225 was a number that we came up with internally based on what we're seeing replacement costs to be for both pools. So moving into 2024, we are going to implement a minimum square foot TIV for all participants in both pools to get those total insured values back up. You'll see at 225, we're still woefully underinsured according to the numbers that we're seeing, but at least it gets some kind of a baseline to start working on. Cindy and I have secured some software products for 2024. We're going to put a lot of emphasis in 2024 trying to get dialed into the regional cost multipliers so we can get these things honed in. But right now, it's imperative that we get a minimum square footage cost factor in there so we don't jeopardize any kind of reinsurance issues going into 2025. Plus, it's just good risk management to at least have more coverage for your buildings. I have seen some buildings coming through for renewal at $60 a square foot. And I don't know if you've been to Home Depot recently, but you're coming out with 2 sheets of plywood for $60. So the costs have escalated. We have not kept pace with that escalation. Therefore, we are showing losses in both pools. So this is the most unpopular thing I'm going to provide today, because I actually do have some positive news for you guys. But I just wanted to drill the statistic home at 66% of the Public Housing Authority pool is woefully underinsured. 69% of that inventory for the affordable housing pool is woefully underinsured. I, sitting as your executive director for the affordable housing pool, was under the impression that the lenders were keeping pace on this, and that lender oversight with the TIV and replacement costs is being conveyed to us. So I was shocked to see these numbers coming through as far as how much of our pools are underinsured, what we feel very strongly are underinsured. May I have the next slide, please, Brian?
Yes, of course. Before I advance, I just want to remind those who have joined us late, we invite your questions. If you would, please type those into the Q&A dialogue in Zoom. There's a button labeled Q&A. It has two speech bubbles. Go ahead and type your questions there. We'll have our panelists answer them at the end of today's town hall. Thank you.
Thank you, Ryan. So we should be on slide 4. There we go. So we put this pictorial together just to let you guys know the other part that is affecting us and has affected us very strongly for the last 4 years is reinsurance. So I'll go through what the reinsurance is. Like I explained earlier, we have a $2 million retention that we retain all losses within the first $2 million for a public housing pool. We retain the first $1 million in our affordable housing pool. On top of that, we go out into the open market with a wholesaler to access reinsurance market. There are literally hundreds of reinsurance companies globally. And we go out every year to bid submission and open this up to all the reinsurers that have an interest at all with providing excess or reinsurance for property exposures. So we go through this process. It used to take us 6 weeks to do this. It takes us over 6 months to do this. And it takes us over 6 months now to create this process and go through this process. We're currently working on the 2024. I do have some good news on that the rates seem to have stabilized a bit on the HARP. We're looking at a flat rate increase for our reinsurance costs. So we're totally stoked about that. That's the first good news we've had on the reinsurance front for 5 years. So that is good news for us. AHARP is not doing quite as well as far as the rate indications for 2024. But I threw this slide up here just to give you guys an idea of what it was like in 2018, 2019, which I refer as the good old days. You can just see the numbers are just staggering what we're having to pay to get the reinsurance. And it's not like our reinsurance our levels of coverage have increased. They remain at $47 million. So we're not getting more coverage. This is just what it's costing to get the coverage to take it up to that $47 million ultimate limit. So you can see the numbers have just escalated huge. And the next slide, that's just a graphical illustration on what has been happening with our reinsurance rates for the last 5 years, 6 years going into it, and you put 2024 in there because we're still working out the fine details of coverage for January 1st, 2024. But this will give you an idea that this is, this has been definitely a driver. And when we determine rates, we have an actuary determine our rates. We just adopted rates based on preliminary information as far as our reinsurance costs last week in a board meeting. But reinsurance is just one of 3 items that goes into building out what the actuaries come back with an indicated rate for what we need to charge for the next year to make the pool solvent. So we have the reinsurance cost, which is a big portion. We have administration cost, which is the cost of us administering the program. Then we have the claims costs and the claims ULAE, which is the allocated loss adjustment expenses for claims. So those are the 3 things: the claims, the administration, and the reinsurance that drive the rates that are provided to us by the actuary. So when you see an increase in the reinsurance, yeah, it is having an impact on the overall rate, but not as big as an impact as one might think. So for instance, this year in AHARP, we're seeing some of our coverage partners. I believe you can go to the next slide, please. Slide 6. This is a structure. So this is a structure graph of what we currently have for 2023. So this is kind of pictorial. It helps me understand the complexities and who's playing part in our reinsurance structure. So like I said, we have $47 million ultimate limits of our property structure. We take the first 2 million for a public housing pool. We take the first 2 million. This is what's graduated to get to that 47 million. So this 4 years ago, we had the 5 million, exit 2 million 3 was taking it all the way up there. So because of the reinsurance collapse, everybody's cut their capacity back, and capacity is what they're willing to to write as far as premium goes and exposure goes in a particular area for a particular risk. So 4 years ago, we had one reinsurer. Now we have this many reinsurers making up our structure. So I say that and provide that pictorial for you because some of these reinsurers that are taking 29%, 20%, 15% of a 5X, a 7-layer, they come and they go. I mean, we've had very few of the original reinsurers that came into our program in 2020, 21, when the capacity reduced. We have very few of these coverage providers, these reinsurers that come back again because they come into the market and they leave the market. So each one of these levels have to give us back a quote on what their coverage is going to cost and what their coverage terms are. So it's our job to make sure that we get the best coverage for the least amount of price. We haven't had nothing but just success for 2024 on the HARP structure. I mean, we've gotten some really good retention with our reinsurers, and on HARP, not on AHARP rather, not so much. But we aren't seeing any sizable rate increases at all on this structure with the HARP program for 2024 from the reinsurers. If you could go to slide 7, please. Ryan, can you advance to slide 7 for me, please? Thank you. So this is the same structure picture that we have for AHARP, which is our affordable housing provider. So we have a lot of turnover in this. We have a lot of turnover in reinsurers participating in this program going into 2024. We also have some pretty steep increases in each one of these levels. So the 5X of 2, which says Princeton ENS, we're seeing a 30% increase in that rate. The 10X of 2 with the travelers, we're seeing a 30% increase on that too. The other ones that you see there, all but one of them are incumbent from last year, and we're seeing single-digit increases from there. But overall, I mean, we're going to experience a 20 to 25% increase in our reinsurance costs for AHARP. What's driving that is there is a renewed interest in what's driving our underlying claims, our claims that are within that first $1 million, $2 million level. So there's an increased interest from the reinsurers on what's going on that level because we have so much frequency and we have severity on those losses. So the reinsurers have become very aware of the permanent supportive housing exposures that are unique to the affordable housing pool. So that is part of the problem that we're experiencing with that, with those renewals for 2024. So we'll get to the rate indicated rates that we have. So I still have enough time for question and answer because this session is for you guys to ask questions. We're here to answer anything that comes up. So I want to move through the rest of this very quickly. So if you could advance to slide 8, please. So these are the adopted rates from the board of directors for the public housing pool last Thursday. So you will see that we have increases across the board once again, but if you concentrate on the property, you will see that we're looking at a 1.5% increase, which is the smallest increase we've had to take for the last 4 years. And a lot of the reason is the fact that we are implementing that $225 per square foot minimum. So if your structures are not insured to that $225 per square foot minimum, you will see increases on top of this 1.5. The 1.5% with the $225 per square foot minimum is the indicated rate from the actuary to fund the program. So we can either take a minimum $225 per square foot minimum, or we could take a rate increase that's passed among everybody. So actuarially, if we were to take the rate increase without adjusting the TIVs to a $225 per square foot minimum, we would be looking at a 26% increase in property rates again for this year. So Those funds are needed to fund the program. So we either take it with a rate increase for everybody, and basically you're still rewarding those housing authorities that are underreporting their TIV, or we get them in line, get them back at least closer to where their actual replacement cost per square foot is, without having a global increase of 26% across everybody. So those were our options for this year. My recommendation to the board, which they supported, was to get the $225 per square foot minimum on the books and in our system, which has been done. And then we can address getting those fine-tuned in 2024. But there's my little glimmer of good news for 2024. Our property rates, the property typically accounts for about 65% of your premium that's paid into the pool, is a 1.5, and we're fully cognizant of the fact that, you know, you might just get a 1.5% increase, but getting that 225 is going to have an impact on what you're going to pay in 2024. But it's a self-correction thing that's overdue. And really, I didn't think that this would become a reinsurance issue, getting those square foot minimums up to something that's realistic. So it's something that we were probably going to do for 2024, but now we're being forced to escalate that as far as timeframes go, just because we don't want to jeopardize negotiations going to 2025 for our reinsurance. If we look at the rate increases, slide 9, please, Ryan. Thank you. If we look at the rate increases have been adopted by the board last Thursday, same scenario, taking the $225 per square foot minimum and applying it against everybody who is under that 225. Even with that and the funding that would be generated by doing that, we're still looking at an 8.5% increase in our property rates. And that is primarily driven by the reinsurance costs this year and our underlying claims, of course. And then on the general liability is 6.6% increase. So the $225 per square foot is confusing, and I try to put myself in your folks' position, trying to figure out what kind of an increase that's going to be. We are poised, both Rachel O'Neill on the public housing pool and Karen Fallows on the affordable housing pool. The system's been built out for this. We can generate some quotes pronto haste. So if you reach out to either one of those individuals, they can get some quotes out to you. So at least you have an idea of what the impact of going to a 225 if your properties are underinsured will be, plus taking the 8.5 and the 6.6 into account. So we are at a position where we can provide quotes to get your at least get you a little bit closer to what your real premiums would be going into 2024. So the next slide, slide 10, please, is just a graphical representation of what our rates have been since 2012. So you see lots of good years in there where they're flat, where the indicated rates from the actuaries are saying we don't need to put more funding in the pool. If you go to 2021, you will see that horrendous number for both those pools. That is 100% due to the collapse of the reinsurance markets. Both pools were able to absorb some of that hit, but we couldn't absorb all of that hit. We have had, over the last, looking at my notes, we've had about a 700% increase in cost for reinsurance for the public housing pool, and about a 437% increase in our reinsurance costs for the affordable housing pool. So we have seen some costs. We haven't been able to absorb all that with our surplus. Therefore, we had to pass these rate increases off to you. So if there's any good news to be had here, it seems like, and I'm knocking on wood here, that things have stabilized a little bit in the reinsurance market. And part of the negotiations and talking with reinsurance this year was kind of perplexing, because we on the West Coast have always been such a horrible risk because of wildfires. And now we're looked at by the reinsurers as more of a favorable risk on the West Coast because of the wildfires, if that makes sense, because they are tired of paying for hurricane, drought losses, windstorm losses, severe thunderstorm losses that are occurring on the East Coast, the Midwest, and the Southeast. So in a weird kind of twist of fate, we're more of a favorable risk to the reinsurers. And, of course, that can change overnight if you had a wildfire, God forbid, or something like that. But right now we're looked at on the West Coast as a favorable risk to the reinsurers. And that's most of the reason why we're seeing very favorable rate renewals for 2024 from at least our reinsurers on the Public Housing Authority pool. So that concludes our presentation, and I wanted to leave as much time as humanly possible to answer questions. So Ryan is moderating, of course, as you know, and he's monitoring the questions and answers. If please ask us questions. This is an open discussion. I know there's been a lot of a talk, especially in the state of Oregon, about captives, and I'll just cover that really quickly. Synchrous has hired a consultant, captive expert consultant, back in March to look at the possibility of having the pools in a joint captive arrangement. And those of you who don't know what a captive is, it's basically an entity that owns its own insurance company. So we looked at that. We had a company come in, they did the actuarial studies, and they've done some consulting with us. I was looking from this feasibility study, I was looking for a go, no go from these individuals, these consultants, and there's just nothing that makes sense. And I shared this with the staff, and I shared this with the board of directors, that I won't entertain going into a captive arrangement unless there's benefits to both the housing, the public housing pool and the affordable housing pool. And after turning this thing inside out backwards, there is no benefit to either pool. So I'm suspending any talk about the captive. I have some other ideas based on some conversations that went on last week with some of my board members. But right now, it is not to HARP, and definitely not to AHARP's benefit, to establish a captive. And I know there's been a lot of talk about this being the end all to solve the problems, but if you look at the way a captive is formed, is exactly what we're doing without the overhead. The way a captive is formed is exactly how HARP is working. We just don't have the hundreds of thousands of dollars of administration fees. So we are looking internally to do some creative thinking for those clients that want to look at having a separate program outside of the pool, but yet still be part of the pool. So I've run this up, the flagpole, with some of my staff members, and I've run it up the pole with some of our consultants. So that's something I'm working on for 2025, but I just want to say that the captive was totally a dead end. It's money that we don't have, that we would spend to get zero benefit out. So with that, I will stop talking and I will let you guys ask questions.
Thanks, Bill. Thanks, everyone. A few questions coming in. Several questions asking whether the slides will be shared with
Yes, they will be. This is being recorded, so this link for the recording will also be attached to your renewal packets that go out. For those that weren't able to join us, they can view this and get a little bit of background, and the packet will be posted on our website. And if you send me an email request at bill@synchrous.com, I'd be happy to get this presentation over to you.
Thanks, Bill. Another question to the panel. Does the property policy still have 125% replacement cost coverage, which in effect would increase the coverage beyond the $220 per square foot nominal amount?
Yeah, the 125%. So when we receive a claim, it will show right on the policy that covers the property, the exact dollar figure that that property is insured for. And so the 125% would be applied to that dollar figure. So once it's up to 225, there will be a certain dollar figure in the policy. And that's what we will use as we handle a claim, up to the 125% figure.
I do want to emphasize that that 125% was built in for several reasons. One, code and ordinance upgrades mainly, and two, for an inflation figure which is really necessary these days because you set your structure values once a year, and that 125% sometimes will help soften the blow of the increased costs of construction during that year period.
And that's another thing that's going on in the reinsurance industry is, and we were kind of cutting edge because we have that 125% clause in our property coverage. More and more reinsurers are requiring that from people that are entities that they insure. So that has been a saving grace for us for the last 2 years, 2 years worth of renewals with the reinsurance, assuring them that we do have a 125% clause, which is now becoming an industry standard requirement from reinsurance on the property end.
Thank you. I would invite from the room any additional questions. No additional questions at this time to our panel. Are there other points of emphasis we want to provide?
Yeah, excuse me. This is Cindy, and I wanted to make sure that to hit on the communication that went out yesterday from the USDA. It allowed for a 30-day comment period on proposed changes to the insurance requirement. I was very happy to have a member share that with me yesterday, and we looked at it, and it basically has about 4 elements: business income, the mortgagee clause, the notice of cancellation, wind coverage, and both the public housing and the affordable housing community pools, their basic coverage structure complies with the proposed changes. So there's you don't have to offer comment. You can let that pass. Your program encompasses those changes as just the standard coverage elements of the pool structures.
Yes, thank you, Cindy. I meant to mention that too, and also that the USDA proposal that's up for comment right now also addresses underinsuring values too, because they are requiring that the affordable housing providers and the public housing authorities insure their properties of 80%, at least 80% of the replacement costs. So that's going to be a new requirement. So that lends further justification to what the reinsurance industry is doing to us as far as bumping those minimum TIVs up to something that's more realistic. So this is the industry trend this year. This is the new thing that slapped us in the face for the 2024 renewals. And we are well aware that this is going to have an impact on your operating costs, but it is in the best interest of both the pool, the 82 members that make up the pool, the 400 policy holders that make up the pool, and you as an entity, to make sure that you don't have any surprises if you have a loss and you're underinsured.
Thanks, Bill. Thanks, Cindy. No additional questions from our attendees today. Are there other points of emphasis, or would you like to conclude today's town hall?
I would just like to close saying thank you very much for your time. And if you have any questions, you have any concerns, please reach out to myself, to Cindy, to Rick, to Tom. Any of us would be happy to answer any questions that you have about the future and what we're experiencing right now. And I would seriously recommend that you talk to Rachel for the public housing and talk to Karen on the affordable housing to get an idea of what the impact of going up to 225 will be on your renewals. We are set to take care of those inquiries right now. So the systems have been built out in our risk management information system. So we should be able to generate some quotes so you have a better idea, because I know budgeting is going on right now. And this would probably be a really good tool for you to know going into 2024. So again, thank you guys very much for your time.
Thank you.
Thank you.
Thank you.
Thank you, Ryan.
That will conclude our town hall. Thank you, everyone, for attending.
Bye-bye.